Hi, everyone. This is Robert from goldsilverpros.com, and today I have on with me Daniel Ameduri, who's a self-made millionaire and a full-time fact finder who credits his success to a strong desire to research economics and surround himself with the right people. After warning family and friends in 2007 about the coming market mortgage collapse, he started his own YouTube channel, Vision Victory, which has received 8 million video views. On March 18, 2008, Daniel called for Dow 8000, the collapse of Lehman Brothers, AIG, and Washington Mutual, and within 6 months, in the fall of 2008, these predictions all sadly became a reality. His website, Future Money Trends, is one of the most widely subscribed to financial newsletters in the world. And Daniel's new book, Don't Save for Retirement, A Millennial's Guide to Financial Freedom, teaches the young generation how to avoid the mistakes of their parents by building multiple sources of income and finding ways to make money doing what they love. Daniel, welcome to the program and thanks for joining.
Well, thank you so much for having me on.
So I've wanted to interview for a long time because I think you and I are kind of kindred spirits in the fact that we both sort of started off our investment careers in real estate. I know that you did a lot of residential real estate and I did as well. And your ideas for how to build multiple sources of income and do what you love really appeal, I think, to a lot of people, especially the millennial generation. So if you wanted to start off there, talk a little bit about your book and why you wrote it and what you're trying to help the new generation with.
Yeah, in the book, Don't Save for Retirement, which your listeners can read the intro in the first chapter at futuremoneytrends.com/save. It's not don't save, it's don't save for conventional retirement. And I think it's been a failed experiment. It's probably, we could go on for hours on just all the problems with it and how the baby boomers had the best bond market, best real estate market, best stock market. Yet according to Vanguard, who's the biggest manager of the 401ks, the average boomer, the median account was only $45,000 for 65 and up. And that was probably a year ago when they did this. So assume it's probably closer to $30,000 at this point in the middle of the coronavirus, which burst the credit bubble. So I think that thinking is dead and it's a failed experiment. So you have to look at the future and what you can do. And a lot of millennials like to feel angry or frustrated that they don't get that 30-year career and that pension. But in the book, it shows them, look, the opportunities are better than ever, whether you want to be a passive income investor or if you want to start a business, you can start a business for $10 a GoDaddy, or you can start a YouTube channel for free. There's a lot of opportunities, but in the book, the main theme is to not invest for capital appreciation, but to focus on buying things that mail you a check.
Okay. Can you explain some of the investments that you have openly invested in and talked about for people beyond just, for example, job income or investing in the stock market? What types of things do you look for and what do you recommend?
You know, I love real estate. I like commercial real estate, ideally to Fortune 500 tenants or even government agencies. Government agencies like the IRS or the State Department, they're not going to ever not pay their rent. Same thing for these Fortune 500 companies. They're all continuing to pay their rent during this crisis, and they will. If you're renting to a bank or an insurance company, you're going to receive the rent. Even the single family homes, which might be having problems right now, this is not a permanent problem. It's a temporary problem that will go away. This too shall pass. The only alternative is the end of the world, and then it doesn't matter anyway. So assuming civilization goes on and people still need to live somewhere, I also like rental properties as well that rent to single family homes or even apartment units. And you can also get into lending money with a security-backed loan, either to natural resource companies. I've done it for businesses. I've done it for mortgages. I own people's mortgages. So there's all sorts of ways you can distribute your savings to where every month, every quarter, you're receiving new income. And you can either use that income and spend it, or you can use that income and save it and buy more income.
Okay, if you could explain a little bit about the advantages of doing private transactions versus going into the public market. I think what I wrote about in my book, Drop Shadow, was the truth about getting a job, investing in a 401k, investing in school, even with as expensive as school has gotten, college has gotten for people, was broken and it's no longer working. What are the advantages of using some of these private investment vehicles over the traditional methods in terms of actually building wealth that you can retire on and not, not hoping and praying? The hope and pray method is what I call it, that the market's going to go your way.
Yeah, I mean, if you're focused on passive income coming in from your investments, it won't take you too long, less than 5 years perhaps, to buy enough income to pay for your basic necessities, which there's financial freedom, financial independence, everybody has their different definitions, but I'm not talking about having enough money for a yacht and $50,000 a year wine budget, but I am talking about being able to pay for your electricity, gas, and groceries. You could do that relatively quickly just by buying income. A lot of people could do it now just by transferring all their stock portfolio into income-producing assets. Mm-hmm. And on the public market side, look, all these retirement vehicles have penalties for you touching your own money. They're extremely speculative in the sense that you only make money when it goes up. But even the basic plan of the 401k says that you'll be withdrawing the money at the lowest tax bracket. Well, what does that mean? Why would I want to be paying? Of course, we want to pay less taxes, but look, if I'm 65 years old, I'm hoping if I've done everything right, I should be in the highest tax bracket because that means you're making a lot of money. So all these 401ks and stuff have restrictions on people, what they can do with their money, and then it gets eaten up by fees and Wall Street. And then, of course, anytime you buy a publicly traded company, they did a study on just REITs, real estate investment trusts. There's about a 33% premium because of the liquidity. Now, the advantage of public anything is that it's liquid. You could sell that REIT tomorrow, a real estate investment trust. A private one you can't sell. It takes 30 to 90 days to have redemption. And during a period like right now, what we're experiencing coronavirus, they will suspend those redemptions altogether as far as getting your principal back. Now, you'll still collect your dividends and your revenue, but if you're always overpaying in the public markets because of that liquidity premium, the click of a mouse premium. In some cases, it might be worth it. In other cases, like if you're looking for long-term, 10, 20, 30-year investments and income, why pay that premium? Why not buy direct? I'll give you a perfect example. When I had a duplex in 2008, that went from $120,000 to $60,000. The rents went from about $1,000 to $1,300 from 2008 to 2011. The rents actually went up in one of the greatest downturns in the markets. Now, if I was only focused on the capital appreciation part, or if it was a publicly traded vehicle, that would have been a hell of a lot of volatility going on there, and your stomach would have been upside down. But if you just focused on getting these checks, in the end, the volatility is not risk. The house, the duplex still pays out today. It's still holding value. But the biggest misconception of people is that you need things to go up to make money, and you don't.
Yeah, I agree with that. I think during 2008 and 2009, when we had the financial crisis, I was renting. I had a bunch of rental properties. I had rented properties for 18 years in the Dallas-Fort Worth area. And I had so many more people coming to me to rent my properties than at any other time. And a lot of them had been former homeowners that couldn't make their mortgage payment, but they had enough money to make rent. So they were able to pay rent. A lot of times it was, moving in with their parents, or the kids were moving in and they were pooling income. But yeah, I agree. The rental market actually in Dallas-Fort Worth exploded in 2008, 2009, and it's just kept going for the last 10 years. Rental property has been a great way to make money in our area as well. That I actually lost my job in 2009. I was working at Ernst & Young as a consultant. Lost my job as one of the top producers in the Southwest area in terms of income brought in. I brought in $7 million from my firm, and they still let me go that year in 2009. But my rental properties really is what kept me going. That's the mailbox money that we had coming in that helped us pay some of the bills. So that definitely did help us out. So I agree, rental properties can be a great way to make money. Can you discuss a little bit about other ways to make cash flow? If you're one of these, it just came out today in CNBC that we had 6.6 million jobless claims, by far the largest number of jobless claims on record in U.S. history. If you're one of these 6.6 million people, how do you focus, instead of worrying about the job that you just lost, finding cash flowing opportunities in this type of market?
It's a great question. I wish I had the perfect answer. And that 6.6 million number is probably even bigger in reality, because a lot of these unemployment websites, like in some cities in California and in Ohio, we know they actually crashed. These unemployment systems and agencies in each state are not made for 50,000 people to phone call them in a day. So there are all sorts of stories about people not getting a hold of them, websites crashing. So, I mean, that 6.6 million number is everybody who actually got to get their application through. This thing could have been closer to probably 7 to 8 million in reality. So it's certainly bad. We've never seen anything like this. In 2008, just to give the listeners an example of comparison, 610,000 people was the peak of these unemployment claims in a given week. Here you've got 6.6 million. And like I said, it could be a lot higher. So we're definitely facing some sort of a severe economic downturn, possibly even a depression, because of the way this thing will unfold. Countries will open and close and reopen at different times. It'll be staggered. Consumer behavior will be changed. No one's going to be booking a trip to Italy anytime soon. People might not want to go to crowds. They might be pulling back on vacations. I don't know about you guys, but let's say they opened up the economy tomorrow. I'm not exactly going to be booking a vacation in 2021. It's uncertain. There's so much uncertainty. Mm-hmm. So when it comes to producing income, you ultimately have to deliver value to other people, perhaps see in your community if there's things you can do. I like how some businesses have started making masks or making other things to fulfill the need, because obviously the needs right now are very urgent and very high. So anything you can do to service people, and you're like, I don't have anything to do with the medical field. Okay, what does the medical field, what does the fire department need, or the local government, or the local hospital workers, what do they need? I've seen some companies turn their like a preschool turn into medical worker daycares. So there's always something, but you really have to approach it with a good state of mind. I always tell my readers, just take a few minutes right now. I want you to think about 10 things you're grateful for, 10 things that you're grateful that are not happening to you. I know it's a weird and twisted way to be grateful, but there's somebody in a much worse situation than you. So don't feel sorry for yourself. Don't get in that poor me attitude. Start thinking about the things that you're not going through. Think about the things you're grateful for. And then once you're in a good state, and again, I would even encourage, if you can, move your body, go on a walk, do something, but you need to get in a good state of mind and then start brainstorming. Okay, what are the solutions and what kind of value can I deliver to people right now? And that's where you're ultimately going to find your income producing ideas.
And I have a question for you. You've talked quite a bit about the difference between investing in speculative markets and what the rich do. Can you and I know you've talked with Robert Kiyosaki about this. What is a way to look at how the rich view money and view investment versus the way that the middle class does? And what are the main differences there?
The middle class and the poor are in a rush to get rich. That's why they're constantly focused on capital appreciation. The rich have the luxury of being able to focus on preservation and income. And it's that mindset, though, that if you apply it to wherever you are in life or economically, and focus on, number one, preserving. Don't lose what you have. That's why I'm a big advocate of gold. So first and foremost, I treat gold as real money. And then focus on preservation and income. So I'll give you an example. I placed a trade last night where I'm selling puts in the market that I am willing to buy gold if it goes lower. So somebody's actually paying me to make that commitment. I already want to buy the gold. That's what I want to do. I want to buy some more gold. But before I buy that gold, I'd like to buy it at an even lower price. Now, that day may never come. It may never go down to 1,500 again. But if that day comes, I'll be obligated to buy it, happy to buy it. And in the meantime, I'm being paid to wait. So there's always things you can do if you just take your time, focus on preservation, and focus on income. And then one thing the rich they don't fall into is being in a rush. So that is another thing. If you find yourself rushed to make an investment, or if you feel like you're going to miss out and you're chasing, like obviously people were chasing this bear market rally last week, or let's say in gold, you read a story about gold shortages happening, and you rush to the buy gold at 1675 or 1665, whatever it happened the other day, and then crap, it went to 1595 or 1585 yesterday. So I just know that it's just the way human emotion works, because that is ultimately the markets, although our markets are highly manipulated and have been interfered with now. But there's still, there's still a lot of that emotion that pushes the markets up and down. So just keep that in mind. Whatever you're feeling, it's probably a good chance that everyone's feeling that.
Yeah, and you mentioned gold, and of course, a lot of our subscribers like to focus on the precious metals. And we started this service in 2018 to help people understand gold, because back in the 80s, about 8% of people had exposure to gold somewhere in their portfolio. And now it's about 0.5%. So Americans have really forgotten the value of gold as a long-term store of value. I agree with you. It is the ultimate money. That's why it's a tier 1 asset for the central banks and why they hold so much of it. But in addition, it's a wealth preservation vehicle. You talked about value investing, Warren Buffett, and saving what you earn and not losing that money. If you look at a chart of gold since 2000, it's beaten the stock market, even the Wilshire with the reinvested dividends. So if you're someone that's trying to save every month, putting a little bit of money into the precious metals can help you save that for the long term, and you don't have the counterparty risks of the stock market or even some other like investment vehicles like bonds, and you have access to it. At the beginning of the program, you mentioned, these retirement accounts not being able to access them until 59 and a half. But if you do access them, sometimes you can get a loan, but you have to pay it back with interest, or you take it out and you have that penalty. You have that 10% IRS penalty plus whatever your tax rate is. With gold, you don't really have to do it. You're making it with after-tax funds. You're storing your savings. You can liquidate that simply by going down to your coin shop or selling whatever paper gold vehicle if you happen to have one that you're invested in. Another one that the millennial generation has been really interested in for the last 10 years are cryptos. So what is your stance on cryptocurrencies? And do you think that that's a store of value? Is it a speculative investment, or how do you treat cryptos?
FutureMoneyTrends.com was probably the first publisher in the world to profile it at $13. And we also helped profile the very first publicly traded blockchain company as well. However, in the past 3 years, we have pretty much closed out our crypto positions and suggested people hold about 2% in Bitcoin. We do consider it a store of value, but it is also speculative because it's new. So I'm not a crypto trader, though we have a huge history with the cryptocurrencies. And, I can tell you, was at one of the first conferences where there was just a few hundred people there. And that's really what turned me on to it, because I was like, man, these are like all Bill Gates and Steve Jobs. I mean, these are just crazy geeks in here. And then there's a bunch of libertarians in here like Max Kaiser. And, the last cryptocurrency conference I went to, this was probably 3 years ago now, but it was 10,000 plus people. So it's a much more mature industry now, but I would still focus on Bitcoin. I wouldn't focus on any of the publicly traded companies at this time. So if you want to speculate, buy some Bitcoin, but just keep in mind, everybody who keeps pointing like, oh, this is Bitcoin's doing this versus gold, or doing this versus the stock market, or somehow the stock market's crashing, people fleeing into Bitcoin. I really think this is just a very speculative thing. I don't think cryptocurrency is moving relative to these other things. I think it's more traders. You got to remember, there's still the vast majority of the cryptocurrency is held in very few hands. So I would just be careful with cryptocurrency and treat it as a speculation that, hey, if it plays out, it'll probably go to 100,000 plus a cryptocurrency, or it could even go higher. But if not, it might go to zero too.
Okay. Do you recommend, especially in volatile times like this, people who traditionally invested in middle-class assets like the stock market, bonds, and so on and so forth, is it advantageous sometimes just to take a position in cash and wait for other investment opportunities? Perhaps it's looking for the right investment vehicle and educating yourself, or perhaps it's just staying out of the market during volatile times. What is your view on holding cash?
I love a lot of cash because it gives you the confidence to make the right decisions. It gives you the confidence to sleep peacefully, to seize on opportunities. And I think right now the market is headed a lot lower. And I would highly recommend people have a high cash position. And I wouldn't even think about shorting it if you're not a trader, because it's dangerous and it can easily go against you. And these ETFs could easily hurt you or blow up in your face. So I would just hold the cash. It's like shorting it anyway. It's just a safer way, because if it goes down, let's say Disney was 145, which is a real thing, and then now it's at like 80. You could buy it at a cheaper price if you were just sitting in the cash position, buy it for a better price. But, I'm kind of looking at a trigger point. I'd like to see the Dow to gold ratio get to about 3-to-1. And then I'll be looking at buying some of the best blue chip legacy names in the business, But we've got a little bit here on the downside here, because the coronavirus is definitely the current crisis that's on everybody's mind. But keep in mind, we were already in a very, very large credit bubble, and we never dealt with the 2008 crisis. So now we have something much bigger. The coronavirus is the pin that pricked it, and it's a doozy too. Because if you think about it, any other pin that would have pricked this bubble, the central banks could have overwhelmed it with helicopter money and probably gotten away with it, or at least extended it or punted it to kick the can. This deflationary nightmare where you've got nobody going to work and businesses aren't even allowed to open unless they're considered essential. I don't care what the central banks do. The only thing they're keeping propped up right now is the stock market. They're not doing shit for the economy.
Yeah. Yeah, it's very difficult. It's hitting supply and demand at the same time. So you see the manufacturing nations like Germany and China getting hit, but you see service economies getting hit. And you see the oil price falling in half. It was in the mid 40s and now it's trading. I think it got down as low as $18 or $19. You can just tell that everything's sort of screeching to a halt a little bit. And that's the really scary part, because if you follow Austrian economics at all, the deflation is what you're worried about in this type of economy, the debt-based fiat money economy that we have. When you have these deflationary pressures, that's really what could collapse big bubbles. And I definitely think in the stock market we have a bubble. The bonds in the US, I definitely think we have a bubble. So we have to worry about those long-term sort of secondary effects of something like coronavirus. I agree with you, coronavirus is causing havoc, but it's what happens to that debt-based system in the long run after the initial shocks of the coronavirus slowdowns are being felt. So I think we'll be looking at the effects of the economy for the next 6 to 9 months probably, or maybe even longer. So definitely something for somebody to look out for. Daniel, I appreciate you being on the program. This has been a wonderful conversation. And like I said, I know we've been trying to get you on for a while. I'm glad our schedules finally aligned up. Can you give our listeners an idea of where to find you and what newsletters you have available for them?
Yeah, if you guys go to futuremoneytrends.com/virus, we have special reports and updates about the coronavirus, and as well as we're sharing anything we're taking action on. But to be perfectly honest with you, right now we're 33% cash, 33% gold, and 33% holding on to our cash flow investments.
Okay. Thank you so much, Daniel. We appreciate it.
You have a good day.